What's up guys, Chris Rivera here, aka the Ecom Accountant. Hope everyone is doing really great. Apologize for the short absence. We got a huge influx of new clients and new faces, and we just want to make sure that we kept our fulfillment steady. But I'm very excited to get back at it. Want to give you guys some free value adds here. Make sure you subscribe, like our video, comment, give us your raw feedback. I'm a nerdy accountant by trade. I don't always know the cool thing to cover, so anything that you think might be valuable or just your general feedback on our channel or videos, feel free to share it. We work really hard to engage with our followers. So without further ado, let's jump into today's topic: how to scale an e-commerce business profitably. Now, I know there's a lot of videos out there on this topic, but I just wanted to weigh in here and give my 2 cents because I see so many different types of e-commerce businesses that I have a very simplistic way, honestly, of monitoring the profitability and margins of e-commerce businesses and assessing whether or not a business is scalable or if they should scale. So that's definitely what we're gonna look into. Now, as a quick plug here, there's a really cool that we put together just for you guys. I'm not gonna capture your emails, nothing like that. It's a completely anonymous. Use the tool as much as you want, free of charge, no emails, nothing like that. We're gonna put a link below, and I'm gonna jump into my computer here in a second and share what that tool is. The whole idea here, before we get into the weeds, is the way I assess e-commerce businesses is inventory markup and return on ad spend. Those are the two items that you should be monitoring very closely to assess the scalability of your e-commerce business. You know, as those of you that are more seasoned e-commerce entrepreneurs may realize or already know, you could have a really great product markup and a crappy ROAS and still have a very scalable business, or vice versa. You could have a really great ROAS but a crappy product markup, on your cost of goods, and also you could have a profitable business, or maybe even wide in terms of your margins. So definitely those are the two metrics that I recommend you track. You're gonna see directly how we monitor that on our end with all of our clients internally. And without further ado, let's jump into my laptop and check it out. All right, guys, so welcome into my computer. As promised here, we're at roasmargins.com. I'm going to leave a link in the description here. No emails, nothing like that. This is completely anonymous, just a tool that we're putting out there that's completely free for you to use. And it's part of a much bigger tool that we're working on the back end here, but just wanted to release some stuff early to get you guys engaged and excited. So let's jump right into it. The whole idea here, just starting from a high level, is these data points drive what your profit and margin are. Now, if you watched our cash flows video, we covered on a very detailed level the difference between profits and margins. You can have really great profits with bad margins, or you could have really great margins with bad profits, right? So they're not always correlated. So just something to keep in mind. They're two separate metrics that you should be checking. So let's jump into the weeds on this. Again, at a high level, what we're trying to accomplish here is understand your business on a core level, and then understand whether it's scalable, and if you do scale it, kind of where you'll end up from a margin standpoint. So where I recommend you start is let's start with what your typical month looks like, right? So ad spend, let's say you're the type of seller that does $30,000 a month on ad spend, whether that's Facebook or Google or TikTok or whatever, you name it. ROAS, right? So let's just plug a 3 here. Let's say you're a very talented advertiser and you have a 3 ROAS on a regular basis. Sales price per unit. So think of this as if you're a one product store, you only sell one product, really self-explanatory here. But actually, I recommend that you make this your AOV, right? So let's list this at $50. Let's say your AOV is $50. And you'll notice here the numbers on the left calculate as we go along, but I recommend going through the whole thing before you look at the profit and margin numbers, so you can get a really great full picture of where you stand. Merchant fee percentage, very straightforward. If you're using, the Stripe, Shopify payments, PayPal, the standard stuff, 3.5% or maybe even lower would be reasonable. If you're working a third-party payment processor like EC Processing or bank card or a company like that, I've seen higher payment processing fees in my experience. So you might see as high as, I've seen 15, 16%, but more typical might be, let's just call it 6%, okay? Typically those third-party payment processors have higher processing fees. So moving along here, dropship or landed cost per unit, really straightforward. If you're a dropshipper, for your AOV, let's say you're one product store, you sell 1 unit per order, what does that 1 unit cost from a dropshipping standpoint? If your AOV is $50 and it's multiple products, try to calculate what the cost is on your average order value, right? So let's just say it's 20 bucks here. Okay, so landed cost per unit, really self-explanatory. If you're the type of seller that buys inventory in bulk and warehouses in the US, then you need to calculate what it costs per unit to get all of that inventory from China to the US in your warehouse, right? Now on top of that, we have a shipping cost or fee per unit. So again, this is not as much applicable to drop shippers, although it could be depending on your relationship with your sourcing agent, supplier, etc. But this is more relevant to the sellers that have a 3PL company or a warehouse that they're paying a pick and pack fee or a shipping fee to get their products from their warehouse to the customer, usually in a quick way. So let's just say you pay $5 between pick and pack fee plus the shipping cost to get to your customer. We're gonna leave overhead blank for now. We'll touch on this a little bit later, but let's take a look at where your numbers shake out. Your sales is very self-explanatory. If you spend $30,000 on a 3 ROAS, it's pure math to figure out what your projected sales look like. Cost of goods. And by the way, as you're going through this, you should be using your own numbers. And if these numbers don't match up to your numbers, then that means one of two things. Either your entries are incorrect here, or maybe you need a different and more thorough understanding on your core business to get a good sense of where you stand. So cost of goods sold, very straightforward. This is calculated on $90,000 on sales based on the inventory markup. Inventory markup is basically these two cost of goods sold fields, dropship or landed cost per unit plus shipping cost or fee per unit, as a variable of sales, basically. So your inventory markup is about 2. So that means if you have $90,000 in sales, right, your cost of goods is $45,000. Makes sense. We're saying your sales price per unit or your AOV is $50 and your cost is 25, 20 plus 5. So it's a 2 markup, right? Then we have merchant fees, really straightforward. We take 6% times $90,000 in sales, $5,400. So your profit is $9,600 or 11% margin. So here's the deal. I always recommend that if you're looking at this, stripping out overhead, because you'll see as you scale, especially fixed overhead doesn't make a huge part of the business. But the whole idea here is, in my opinion, to have a safely scalable business, you want to get this margin percentage somewhere between 15 and 25%. Now, let's say, let's say this is your situation, how can we adjust this? There's plenty of ways. One way could be you raise your price per unit. Will it affect more your conversions? Yeah, probably, but maybe your AOV will rise and it won't affect your ROAS too much. These are things that you have to monitor. So let's say you raise your price per unit by $1. Let's say you go back to your supplier and say, hey, look, we're scaling up. We've done a lot more business now than we have before. Let's drive our price down to $19. Look at our margin now, we're up to 14%. Let's say you go to your payment processing company, right? And you say, listen, we need to renegotiate. I'm paying higher fees. I'm gonna go back to Stripe, Shopify payments, PayPal, etc. Let's say they drop you a point. Now you're up to 15%. Now the whole idea is here, let's say this is an ideal spot. You wanna be at 15%. Now you wanna see, okay, if I were to spend, instead of $30,000 a month, $60,000 in a month, where would my margins end up approximately? So if you spend $60,000 in a month and maintain that 3 ROAS, you're gonna end up at $180,000 in sales, and obviously you'll see the rest follows here in terms of where you shake out, and you maintain that 15% margin. Now let's jump back down to $30,000 in ad spend, and let's add some fixed overhead. This is a very important concept to understand, and one of the most valuable parts of this tool, in my opinion. Let's say you have a team of VAs, right? And they cost you $4,000 a month, right? At $30,000 in ad spend, based on these parameters, you're at a 10% margin, which may not seem so great. But check this out. If we bump this ad spend up to $60,000, now you're at a 12% margin. You know, if we bump it to $100,000 in a month, you're at a 13% margin. You know, so the fixed overhead essentially gets diluted into the margin because it doesn't move. As your profits increase, the fixed overhead doesn't move. So definitely something you want to consider as you're determining whether or not you have a scalable business on a small scale. And then the last thing we added here, for those of you that are interested in having variable overhead, we just made this a percentage of your total sales. So let's say, you know, just for math so we can make sure it works, $300,000 in sales, 30K variable overhead because we plugged 10%. If you wanted to say like, hey, as my sales rise, you know, my variable overhead is gonna rise, you know? So let's say you just use 1%. You wanna have like a conservative estimate here in terms of what your profits are. So you can plug in any percentage you want here. And you can have both of these, you know? So your variable overhead is $3,000. Let's say you have $2,500 in fixed overhead. You know, you get a sense of where your margins end up. And that's pretty much it. Thanks so much for watching our video. Please, as a reminder, subscribe, like our video, comment, give us your raw feedback. I wanna know what you guys wanna see, like to see, or just tell us we suck. Whatever it is, be sure to leave your feedback. Have a great day, guys.